weekly chart also looks phenomenal, but there's that $2,300 level on RTY that I had marked that it still is below. So I was kind of watching that, but yeah.
Got to be right. Yeah, it's like right at that. Above the 200-day moving average. Went down, almost touched it yesterday, and up, I don't know, 5% since then almost.
Yeah, yeah. Well, we'll keep you informed on if we go all in on small caps or not. I'm personally not there yet. I still believe there's some catch up left in the mags, believe it or not. Tesla, as we'll talk about a little bit, I think today. Anyone read that little Tesla catch up report that we put together yesterday? Just kind of showing how much potential Tesla has relative to the rest of the market, other Mag 7, and just a couple key reasons why there's obvious catalyst. Now, I'm not going to sit here and tell you, Tesla's guaranteed to go to all-time highs, but it's one of those things. If history repeats itself, it's got a pretty good track record of recovering and then some. So I think it's still. I mentioned this on the roundtable going back 3 months ago. I think it's still probably the best risk reward trade out there right now, just with how much upside there's still left in the tank. So we'll talk about that a little bit. But first, we're going to jump into what I think is one of the most important tradings that there is. I mean, not to pat myself on the back here, but I don't think you're going to find this on mainstream financial TV, how to trade this way. I think it's incredibly important to understand this for retail traders, because it goes back to what I always say about creating more scenarios for you to win and all that sort of stuff. And then I'm going to give you a pretty crazy example of how this actually played out. And then I'm going to kind of prove it to you on mass scale that it actually works. You're not just taking my word for it or the theoretical example or my ugly drawings of how it could work out, but I can actually prove it to you with some data. Then I've got a surprise for you on top of all of that. So hope you guys enjoy what I put together. I redid this whole training, added some stuff to it, and I think it's going to be good stuff. So with that, let me dive in. Unless Graham, you have any trade ideas or anything that I'm skipping over here because I'm about to geek out. So
No,
stop me now.
I think this is perfect. And I see we have Jack here too. Jack, I know this is something that you've been doing as well with your Tesla program, which has been really doing well. So,
Yeah. All thanks to you, Graham.
yep.
Well, I'm gonna give you a perfect segue then, Jack, to talk about Tesla after what I lay out here. But just bear with me as I geek out for 45 minutes and go kind of in the weeds here, and then it'll be a good segue into that. So I'm going to ask you guys, as always, to use the chat. Give me some feedback as I go through a couple of these examples, so I don't feel like I'm talking to myself the whole time. Deanna, if make sure that chat is open, please, if you would, so that folks can, everyone can see. If they want to, you can just change that little blue box to everyone once the chat is open. I'll ask you a couple questions along the way. And as always, I'd love your feedback. So
there we go. Bodine's got it. And also, you guys are awesome, because a lot of times, Nate, I've noticed people helping each other in the chat. So that's great.
Yeah, which is fantastic. I mean, I love the community that we've been building here that's one of the many reasons. So let's jump in. So today I'm going to make a bold claim and tell you that I think I'm going to give you the single biggest advantage for retail traders, period, end of story. I really believe that. If you understand the two dynamics we're going to talk about today, many of which you guys have heard us talk about, but I'm going to try to give it to you in kind of a new light bulb format that I think will change the game. So you can sum this up in basically two ways. Number one, creating more scenarios where you win, right? That's the first thing, creating more scenarios where you win. Along with that, you could kind of say it this way, turning losing trades into winning trades. Because as you'll hear me say a lot, what retail traders are typically very good at is turning winning trades into losing trades. That's what retail traders are great at. What we want to do is flip that around and turning losing trades into winning trades. Now, the key here is that most traders open a trade with very few ways to win and many, many ways to lose. I mean, as you'll hear Jack talk about all the time from the institutional days, this is why institutions make so much money, because retail traders open up trades with a whole bunch of ways that they can lose and very few ways where they can win. So for example, they jump into a trade, they're going to buy a call option where the stock has to go up to make a profit. They're going to buy a put option where the stock has to go down to make money. And the challenge with those regular options is that you're battling the timing, the direction, the implied volatility, all at the same time. As soon as you open up that trade, you have to overcome all of that, which means you don't just need the stock to go up. You need to go up a lot at the exact right time, and then you need to make a perfect exit, right? All at the same time, which is why some recent studies suggested not 76% like the CME, but up to 90% of regular options lose money, which is just crazy. I mean, I know, Jack, you and I have talked about that 76% number. There was a recent one that Graham and I found that said 90% now.
I saw that. Yeah, just straight option buyers are getting killed.
Which makes sense, right? Because options have exploded. They're charging higher premiums. It makes sense. The win rate's going down faster than ever. So most of you know that Graham and I like to flip this on its head by using a line in the sand. And this alone is extremely powerful because it completely changes the winning scenarios. So think about it like this. Regular call option, you have to overcome that area, just have a chance to profit. We call that the implied volatility that you have to get above to have any chance of making money. So while you might be entering the trade down here, your line in the sand to actually make money on a call option is way up here. And by the way, it's changing all the time, right? Because if it's early into the trade and it moves up, you have a higher chance of making profit. If it's later in the trade, you need a bigger move because now you have more time decay. So you don't even really know often where you need the stock to go on a regular call option to make you money. And you have to get the timing and the exit right to try to make a decent profit. Now, if you have the line in the sand below the current price, which is very common for me, it flips that area. Instead of having to overcome a area on the chart to get into profit, I now have a cushion, as you often hear me call it. I actually have room to the downside, protection, which means price can go up, price can go sideways, price can go down a little, price can actually even go down a lot and then simply bounce back up and finish above the line in the sand. And we can still win the trade. And by the way, the cool thing about this is you still get the full profit on the trade in all of those scenarios. Whether it finishes 1 penny above that line in the sand or $100 above that line in the sand, you're still entitled to the full profit of the trade. So hopefully that alone shows you why the line in the sand just flips that scenario around. But today, we're going to take it a much deeper step further. Okay, so again, line in the sand alone, I think, is about as big of an advantage as you're going to find, but we're going to double up that advantage. Remember our goal. More winning scenarios, right? That's the idea here. And so the biggest hack for that, just to create more winning scenarios, excuse me, on top of those trades, is using a good till canceled limit order. In other words, a target, putting a target on a spread. Now, I had never even heard of using a target on a spread trade until I accidentally discovered it doing it myself. I'm sure I'm not the first one to do it, but I never heard someone talk about this. I don't think this is out in the mainstream idea of creating a line in the sand and then using a target to get you out of the trade with more advantages. And that's what we're going to talk about today. So instead of waiting for a trade to finish above the line in the sand, we set up a target so that at any point a trade shows enough profit, our broker automatically clocks us out of the trade. Now I'm going to pause here for a second because I think this is really important. How many of you guys have made good trades, but you're not watching the chart, and so you simply don't get out? You simply don't take your opportunity to exit for a profit, even on a good trade. I mean, I assume I'm not the only one who has done that. So just in general, before we even get to the mathematical advantages and everything else, just the idea that the broker is going to handle the trade for you, whether you're watching the chart or not, I think is going to be massive for most retail traders because exits are harder than entries, in my opinion. Mm-hmm. So imagine you take a trade here with a line in the sand here, right? You buy the 200 call, you sell the 205 call, you have an expiration date here on July 31st. Now, what that means in practice is that if the price finishes above $205 on July 31st, you're going to win the trade. By the way, if you flip that around and did a credit put, same idea. If it finishes above that line on a put credit spread, same idea. I'm using a debit spread, but you could flip it around. But the point is, if it finishes above that line on July 31st, we're going to win. So it could go mostly up. It could go mostly sideways. It could drift down. It could even collapse down and then bounce back up by July 31st. And all of those scenarios result in a full win for the trade, which is pretty amazing in and of itself. But to give us even more profitable scenarios, we can place a good till canceled target on the trade, that limit order that the broker is going to look to fill for us. Because while it's great to win, if the stock does this and it finishes above that line in the sand on the arbitrary day, that's fine. Well, if the stock happened to look like this instead, where it bounced first and then fell, then we lose the trade, right? Now you're turning the winning trade into the losing trade. You're reversing that scenario. And this becomes even more important if you want to trade more aggressive lines in the sands where you don't have the big cushion. In other words, in all of these scenarios that I'm just showing you, you have lots of cushion. But if you want to get more aggressive, you're going to have less cushion. So this is something that I would typically do in a strategy like automated options, right? Where I have a line in the sand that's actually above the price. So we're playing with a little more fire because we're going for more profit, which means we don't have quite as many scenarios to win. We still have lots of scenarios, but not quite as many scenarios to win, but we're getting the big profit trade-off. So this, for example, this would also mirror what Jack would do on his Tesla trade. He's not going for a defensive 10% trade. He might hit a 50 or an 80% winner by being more aggressive on where that line in the sand is. So here's the question, and I'm hoping that as we go through this, you'll kind of have that light bulb moment as to why I think this is the biggest advantage for retail traders out there. Because anytime you take a trade, like we just looked at with a line in the sand, you also have a window of time for that stock to make its move, whether it's 1 day, 5 day, 30. Every option has an expiration date, right? So you're giving that trade a window, whether you like it or not. 1 day, 7 days, 30 days, 500 days. No matter what, you're giving that trade a window of time. So your window is something like this. Okay. Now, again, it doesn't matter. Over here, I said this was July 31st, right here. But it doesn't matter. That could be tomorrow. That could be December 2026. It doesn't matter. Wherever that expiration date is, you're going to have a window of time between when you enter the trade and when you get to that expiration date. Okay? So here's the question. Do you think your odds as a trader are higher of picking where the stock will be on that particular date, whether it's July 31st or December 2026, or that somewhere in that window, the stock will move up? Okay? So seriously, answer in the chat. What do you guys think, hey, as a trader, my odds are higher that I'm going to pick that the stock's going to be right here on this date, or that somewhere in this window, we're going to get a move up? Which one is going to be easier for you as a trader to pick? Somewhere in the window or at the exact date?
Window.
Right, of course. Right? Pretty obvious that we're more likely to get a pop somewhere in the life of the trade than predict where the stock is going to finish. You guys are right. You're exactly right. And I'm actually going to prove that to you with data here in a second as well. But the fact is, most stocks don't move in a straight line, right? I think we can all hopefully agree to that. So if you entered a trade here, right at the beginning of this particular window, and you have a line in the sand here right around the current price, which is often how, I would trade automated options or Jack would trade Tesla. Well, if your trade expires on one of these days, great. You're going to win, right? Those are all above the line. Well, if it expires on one of these days, you're going to lose. By the way, even this one, which is a good example of sometimes what happens and is brutal, day opens way above your expiration. By the end of the day, you've got a full loser on your hands, right? That's not fun. Okay, if it's one of these days, you're going to win again. So on and so forth. Lower, higher. So, lots of different scenarios. My point being that predicting where a stock is going to finish can be really tough. If you have to just pick one of these days, which one are you going to pick? How are you going to pick it? Are you, somehow likely that the fourth day is going to be higher? Good luck, to be completely honest. But the GTC limit order, that target, changes up the scenario completely. Instead of needing to pick which candle is going to finish where, we just lay a blanket of profitable outcomes over the chart. Okay? We just say, listen, if this is worth a certain amount at any point during the trade, cash me out, baby, I'm going home. So that any time the price hits that range during the window of the trade, we can exit with a win, and we don't actually care where that trade expires. Now, let me give you guys a wild, real example from this, not from 6 months ago, from just yesterday. Okay, so I'm going to give you a crazy example from yesterday that Graham tried to ruin at the beginning, and then I will prove it to you on a larger scale. Okay, so July 15th, this is going back to Tuesday. I sent out my overnight option trade right here. This is the SPY. I sent out the overnight option trade. Now, my line in the sand was here, right below price, because I put my line in the sand right below price on overnight options. And my expiration was the end of the day yesterday, which is right here. Okay, so does this trade make sense to everyone? Everyone see this? I entered here. I put my levels here. It expired yesterday at the end of the day. So I needed regardless of what happened in between all this craziness, needs to finish above here to get me a profit. All right. So I needed the market to finish above that level at the end of the day. The market opened and it started actually heading down by about 10 a.m. And that is where things got interesting. Because right here, Graham's 60-minute trade fired off. Okay? Only it fired to the downside, not the upside. So Graham took a bearish trade with a line in the sand right there with the very same expiration. I took mine the night before with yesterday's expiration. He took his yesterday morning with yesterday's expiration, which meant he needed price to finish below his level at the end of the day. Okay, so I had a trade up there that needed to go above. Graham had a trade below that needed to go below. Now, I'm no rocket scientist, but I know that price can't finish in both places on the same day at the same time. But the key to yesterday is that we both had targets on our trade. So when the Powell news came out right there and shot the price lower, Graham hit his target and got out of the trade having no idea where the day would finish. Right there, as you can see, as the Powell news broke. And then when the market popped back up, after that turned out to be fake news or whatever else, I hit my target having no idea where the market would end up. So we traded in opposite directions with diametrically opposed lines in the sand with the same expiration, and we both won the trade on the same day. Now, hopefully, that gives you a bit of an aha moment, because that's insane that happened yesterday in real time. And that can only happen because one of us turned a loser into a winner. Now, I get to say, happily in this case, it was Graham whose trade would have ended up being a loser. So I'm the better trader from yesterday because my trade would have won no matter what. But Graham turned what would have been a losing trade, actually not into like a 10% winner. What was it, Graham? 50%, right?
Yep, 50%, $1,000 for me.
So Graham made $1,000, a 50% winner on a trade that would have been a losing trade under that quote unquote finishing scenario. All right. Now I think that's just insane. But let me show you what that looks like at scale. And hopefully this will also blow your mind. My goal is to blow your mind in multiple ways today. So let's try something else. Okay. Let me show you. Let's go to something here. What I'm going to do, let me shrink this down a little bit. What I'm going to do here is I'm going to run through a scenario of a situation that should be a winning trade or a winning strategy. Okay, so let's set up some criteria. Let's go back and take this to 2015. So I'll do July 17th. So that's 10 years. I'll trade on the SPY. I'll do a long call spread, which is typically what Graham and I trade. I'm going to change this to percent and percent. I'm going to buy the call that is 0%. That's flat. That means like kind of like what Graham would call a wrap order. And then I'm going to sell the call. That's 0.5% out of the money. I'm going to give it 60 days. I'm going to set up this trade. Now, you guys probably have no idea what I'm doing right now. Don't worry. You'll see it in a second. What I'm doing is I'm creating a debit spread that gives the market 60 days to go up about 0.5% over the course of 60 days. I'll use 10% allocation there. And this should be profitable because the market generally goes up over time. I'll do monthly, first Tuesday of the month. 9:45 a.m. I don't really care what time it is. And let's go with that. So let's go ahead and
question.
Yeah.
Question. What platform is this?
This is called Option Omega. It's an option testing platform where you can do these different spreads and strangles and all that kind of stuff. So this is basically your most boring debit spread ever. You're going to give it 60 days and basically say, hey, I'm betting that more often than not, the market's going to finish, higher, 0.5% higher over the next 60 days. Flip a coin, more often than not, this should be profitable. We'll see what our data shows us, but should be profitable here. Just give it a second to run. It says 30 seconds. I think we're coming up to it. Oh wait, I didn't give myself enough margin. Hold on. What'd I do? Buy call. Oh. No, that's right. 60.5. You guys can tell I'm doing, use exact DTE. We don't want to do that. We just want to get in the right range. Okay, let's try that. You guys can tell this is not prefabricated. We're doing this in real time to run the data. Jack, those were debit spreads that Graham and I did in opposite directions. I did a bullish debit spread. He did a bearish debit spread. That's why we had the line in the sand. You can't have a line in the sand with a regular option. That only happens if you're willing to trade spreads and flip those scenarios around. And if you want to get the really, really deep details on that, you can watch my debit spread training that I did, which goes super deep into all of that stuff of why a debit spread works, how the line in the sand works, what happens when the trade expires, all that sort of stuff. That one's really deep. All right, come on, baby. Let's move into high gear here.
What else is key here while we're waiting is that both of you put that good till cancel order for your exit right when you get your fill. So you could be out fishing in motorcycles. You don't have to try to pick that top, right? You're just going for your profit.
I was actually,
exactly.
I had to go pick up my daughter from one of our neighbors' house. They were watching her. Walking up the stairs, I heard my Thinkorswim account go dring. So, oh boy, sprinted up the rest of the stairs to go take a look.
All right, so we got a strategy that is profitable, right? And it makes sense, right? Because if you're going out, if you're trading bullishly over the last 10 years with a debit spread, you're probably going to make some money. So, guys, help me remember some of these numbers. We got a 76.1% win rate. We've got 65% drawdown. We've got 22% capture, 839K ending. Okay. Now, what we're going to do is we're going to take this exact same test, all the criteria, everything the same, and we're going to slide down here, and we're going to put a profit target in. Now, I don't know what profit target would be optimal. We can test it and have some fun if you guys want, but I'm just going to do 25. That's a conservative one. That's basically almost guaranteed going to boost that win rate some. And everything about the trade is the same. The only thing I'm going to change is the profit target, and we'll see if we can make this a little bit better. Now, maybe 25 is not the best one. We can mess around with it here and see what the best profit target actually is. But I'm going to just about guarantee you that the win rate shoots up. The equity curve is probably going to be a lot more stable as well. We'll see if it's more profit, less profit, all that kind of stuff.
And Nate, you may have mentioned this. How many years is this going back? 10 years?
10 years.
We're getting 10 years of data here in about a minute.
All right, so let's see. Let's give it a minute here to churn, and we'll see. So remember, this is what the equity curve. You can kind of see it still blended out. 76% win rate. And
wow.
Oh, baby.
Wow.
This worked even better than I thought. Look at that win rate.
Where'd the market corrections go on that chart down there?
Boom. All right. What do you guys think?
I love it. What did you change to get that curve better?
All we're doing is using that window. Any pop anywhere in that window, we take our profit. So instead of waiting for all those trades that would have been profitable that ended up being losers, we took our profit anytime we got the value up. So I don't know about you guys. We just turned a 76% win rate into a 91% win rate. We cut our drawdown by 70%. We added $600,000 in net profit. And all we did was add a target. Now, we can do a couple more. You guys want to try more or less? Someone said, okay, let's try 40. Let's run 40%. We'll see what that is.
Pete says, wow, wow, wow. I agree. Nate, this is great what you're showing them.
So I told you, I didn't want to just give you a theoretical and some ugly drawings. That's, Jack, what I'm kind of known for is scribbling on the screen with my marker and making ugly examples. I wanted to go one step further here and actually use some data. So hopefully this kind of proves the point to you.
It's
Kathy, this is not a program. You could start putting in these trades today. It's just a debit spread 60 days out.
Yeah.
Right around, with using Graham's wrap order. That's basically what it is.
Yeah, your average days in the trade is only 19. That's fantastic.
And look, perfect point there, Jack. You said 19. When you up the target, what happens? Your average days go up, right? Because you're waiting more time on average to get a bigger target. But good idea. Whoever said 40, we just took our profit to 3.3 million. Whoever said use a 40% target. So you guys can see, I wasn't giving you some optimized version. I just literally threw a dart out there just to show you real time the data. So, so I think this is pretty awesome. I'm hoping that, kind of blows your mind to see when I say winning, more scenarios looks like. I mean, we just, and of course, if you guys wanted to go and do a really small target, like 10%, your win rate would go through the roof, but you would probably lower your total profit quite a bit because now you're too far on the other side, right? You're too far. You're protecting too much of the profits instead of going for, getting the risk reward right. And this is what I love about what Jack's going to talk about, that Tesla income trade. The blend there is beautiful. I mean, I don't have the numbers right in front of me, but I know the average win there is really juicy, and we're still keeping the win rate pretty high. So Jack will talk about that in a minute, but it's kind of that balance. So here you guys can see exactly what I'm talking about. Win rate's really high, but profit is way less. Why? You're just not getting enough bang for your buck when you enter that trade with that low win rate. So whoever said 40%, that's probably about the right window for something like this. You guys can mess around with this all day. I mean, I do this all day. So hopefully that makes sense. Now, let me jump back in. Let me cover a few quick things here. Sorry, Jack. I told you I'll geek out, and I'm eating up some of your time here, but
no, I love it. I love what you're showing people here.
So the next question is the math part. This is the part I always get. Where do I put my target and how do I calculate that? Right? Because it's easy to say, 25% target or 30% target, or we should use a target. But then the problem is calculating the actual values, which is why I spend so much time, if you guys attend my master classes, doing doing the boring stuff. If you take a $1 spread, that means your max value is $1. If you pay 37 cents, that means you have 63 cents left of profit potential. I hammer that ad nauseum because I think it actually really helps if you understand the math. But I know that a lot of people ask, okay, but how do I actually figure that out? So, of course, I built a calculator for you. Now, my calculators aren't as pretty as Graham, so maybe I'll let Graham make this prettier for you. But this is what I did. So we're calling this I made a very interesting name here, the Opening Playbook Bonus GTC Calculator. So what this is going to let you do, guys, it's going to let you put in your figures for the trade, and then it's going to give you what those targets would be so that you kind of understand. Because if you just say, hey, I did a $2 wide spread, I paid 37 cents for it, I want to use 50% of the profit potential, I'm guessing half of the people in here don't even know how to calculate that math if you're still relatively new. So I want to do it for you. So someone give me a debit spread. What, you want to trade Apple with a 200 call and a 205 put? Okay.
And Nate, real quick, send me this link because you are right. This thing is not pretty.
Yeah, I knew you would complain as soon as you saw that. I purposely didn't show Graham this ahead of time because I knew he would say, you can't show that. It's too ugly.
What do calculators look like if you don't think this is pretty?
I knew, see, Jack would back me up. I purposely did not show Graham. He always
Jack has your back.
Yeah.
But he doesn't have a pretty calculator.
So, guys, all you need to know is the spread you're trading and how much you paid for it. So if you did a 200, 205 spread on Apple and you paid $3.25 for it, this thing's going to pump out all the numbers for you. It's going to say, okay, 325, so your max risk per contract is 325. Your max reward is 175. Then you just tell it, okay, how many contracts am I trading? Well, I want to trade 86 contracts of Apple, baby. I'm going heavy, right? Well, now my profit potential there is, or that's actually my total. See, this is why Graham wouldn't let me do it, because I have words wrong and everything in there. My total risk is 27.9 and my total potential is 15,000. But this is the part that I actually built for you down here. These good till target or good till canceled target ranges. So if I want to go for 25% of the potential, the potential left on the trade, I would put a target in for $3.69. If I want to go for 50% of the potential on the trade, I would put a target in for $4.13. If I want to go for 75% of the profit potential, I would put a target for $4.56. And if I want to do a 90% profit potential, I would put a target in for $4.83. And then underneath that, it's going to tell you how much you would make in all those different cases. So instead of making the full 15, I wanted to make 11,287, et cetera, et cetera. So this is just there for you. We'll add it to the opening playbook. VIP, Graham will make it prettier, and then we'll put it in there because he can't abide by my ugly calculators in his members area. And if you guys are VIP members, you will get this calculator. You can play around with it. And that way you never have to ask, well, how much is... oh, see, look, Graham, I have more typos in here.
Unbelievable.
Okay, well, to be fair, I did this 7 minutes before opening playbook started. Okay, so I was...
It's good. It's good.
Yes.
I was realizing the question I was going to get is, okay, well, how do I calculate that for my own trades? And so at the very last minute, wow, I'm doing this in real time and still making errors. At the very last minute, I was realizing I'm going to have to build something so people don't have to ask that question. But don't worry, guys. Graham will audit me. He's the perfectionist. He'll make it pretty. And then you guys can get it in the members area where you can see, hey, if I plug in, just like, you know, if Jack gives you a Tesla trade, he says, hey, buy the 320 call, sell the 330 call, pay 550 for it. Well, now you can say, okay, well, I'm going to do 3 contracts. You're going to know I'm risking 1650 to make 1350. But if I want to use a different target, here's what I would put a 663 target for 25% of the potential, but I would put an 888 target if I wanted to be more aggressive and make 75% of the potential. And you can plug in any trade you do, whether it's one of our trades or just a trade that you are looking at. You can do that. So that'll be in there for all the opening playbook VIP members. If you guys haven't paid your dollar yet, you can do this. Jack, what we do for our editorial sessions, the 10 a.m. is always free, as you know, but we build a little members area where we host all of our scanners and our calculators and our training decks, and we charge $1 for that because, you know, the technical team always has to be a nuisance and tell us, well, we can't technically give you a fulfillment area unless they pay money for it. Yeah. So we charge $1 lifetime access.
Now, can we just go through a couple of the finer points here that I see some people are asking questions about? Now, the first thing to know with a debit spread is that it makes the trade so much more affordable, right?
Yeah.
We're doing some of these options. One call could be $1,500. But if you do this with a spread where you're also selling an option, you can get that trade down to $100 instead of paying $1,500 for a call. Now you're in for $100 and some dollars, and you still have a great profit potential. Now, one thing also, when you enter this order for the debit spread, you want to enter that on a limit of just the debit you're willing to pay.
Yep.
Right. That's the limit. So if it doesn't get filled, it doesn't get filled. If you're on a limit, you can put this all on one order. So you just have a limit on that debit. And if you get filled, then you're going to go back to that trade and put it up for sale to close out those positions. And you're going to put, again, another limit on your profit. Just if that gets hit, then you're going to get taken out. And that's on a good till cancel, right? So you get filled on a debit, on a limit. Immediately, once you get filled, you put that for sale, good till cancel on your limit as well, which is anywhere 25 to 50% more than what you spent on the debit.
Yep.
You know what your limit should be on the sale, Christian? That's going to be how much percentage you want to be. When you enter, it's going to be about 50% of that spread.
Yeah, how much juice do you want to squeeze out of that? Like we were just running those tests. So if you guys look at my broker, you can see I got filled today on these. I got an 89-cent credit. That's what I asked for. The broker's not going to fill you for 77 cents when you put a good till canceled limit at 89 cents. It's going to fill you at 89 cents. Now, a whole bunch of people ask, what about expiration? Guys, your expiration doesn't matter for the limit. Now, it matters for other things, but it doesn't matter for the limit order. Your limit's just based on what you paid versus how much of the profit you're going for. The expiration is going to tell you how much time you have to hit that limit, but it's not going to matter for the calculation of the limit order.
Correct.
All right, and yes, we'll get it. We'll get it in the Opening Playbook VIP members area. Like I said, Graham's going to audit it and clean it up and make it perfectionist, and then we'll get it in there.
These calculators are priceless, because it's very difficult to just pick a trade like this and do it all in your head, right? When you can look at different scenarios real quickly, you could find an optimum trade in 5 minutes.
Well, and one of the things, Jack, if people want to go aggressive. No, that's not the right word. If they want to go deep, I guess would be a better word. They could throw this Tesla trade on, put 3 contracts, and put 1 contract at each level, and kind of ladder that. And then they could learn in real time. Okay, looks like the 50% target's getting hit quite a bit. Looks like the 75% target's not getting hit. And they could kind of do what we were doing over here on this test. They could do that in real time with their own trades and kind of optimize the level of target they want to go for. So, that would be kind of hard to do in your head, but the calculator makes it pretty easy.
That's the Tony Saliba, right? He likes to do lots of 3, whether it's 3, 6, 9, 90, whatever. Then he'll put the first batch of the 3 out at 10, 15, 20%, whatever. Put the second batch out 50%, and put the third batch out for the home run.
Exactly. Yeah. So
John posted here in the chat too. He said Tom Sosnoff, who owns or started Tasty Works, he also built Thinkorswim.
Yeah,
he did some very extensive testing on debit spread. His sweet spot's 25%. So
which I could believe, because that was at the right around my highest level on overnight options was about 18%. On some of the other ones was right around 20%. Some of the other ones was right around 25%. So I think in that range. But if you're giving it more time, again, it's not going to affect your calculation, but you might end up being a little higher. Like if you're trading SPY, like we just looked at for 60 days, you're giving the SPY 60 days to move, you can probably be a little more aggressive.
Right.
You're giving it 1 day to move, maybe a little less aggressive. Now, this is going to bring up, hopefully this gives you a whole understanding of why this is a big advantage, but it's also going to bring up some questions like, all right, well, now how do we best execute it? How do we pick the stock? How do we pick the timing? Which target do we use? And so I was going to hand it over to Jack. How many of you guys would like to hear about an optimized version of doing exactly what we just talked about, getting that timing right, getting that direction right, and doing it with a particular Tesla strategy that Jack built that kind of, you're not guessing any of these numbers. I gave you a lot of ways that you can kind of figure out how to do this, or you could kind of follow the blueprint that Jack does on Tesla. And the cool thing about Tesla, you guys think that, the SPY tends to move up and down and give you lots of chances to hit your target. Well, Tesla, I mean, talk about a stock that's going to move up and down over the window of a trade and give you lots of chances to get out with the winner. Tesla's kind of it. And well, we have the testing to back it up that it, in fact, is it. So Jack, do you want to jump right into it? Do we want to play that presentation? Do you want to give kind of an intro to how do you want to do this?
Let me give him a quick intro, and then we'll get right into the
okay.
To him. The thing about Tesla is it's a very unique stock in that sometimes even when the stock is not the most traded stock by volume, oftentimes the Tesla options are the most traded options by volume. And that's a really big factor in this. It gives us tremendous liquidity at all kind of different prices. And the beautiful thing about Tesla is the unique phenomenon with that stock is that it's not uncommon for it to make a 1% to 2% move at any time. So we're in these trades. Our expiration's about 10 days out, and all we need is that 1% to 2% move. And it's not based on Tesla trending higher. It's not based on Tesla trending lower. That's the weird thing about it is almost 100% of what I do is based on the stock's underlying trend. This is based on Tesla's inherent volatility at any time. Even when it's trending lower, it can make a huge pop. So we get these opportunities to turn a $5,000 trade into $1,000 almost every week. But one key piece of it is we have to get the green light or there is no trade. And that's what we explain in the in the training. And then again, I got to give a major shout out to Graham. Really just great work behind the scenes on this thing, and great way to trade it. It's a very simple format we use. We've got great training also with this Tesla, and we've done some live master classes. We all did a trade together where we were out the very next day. So we've had a lot of these trades where we've hit that profit target that we put in ahead of time. We've hit that the very next day. Now, don't expect that, but that's how powerful the opportunities with this Tesla payout program are, and it's why I love it. It's also fun.
Yeah, and definitely. And the payout this week was pretty quick too. And we were able to, if you guys like that option Omega testing Nate did